Hi, my name is Christian Walgrave, Head of Research at Teekay, and this is our conventional tanker market update for September 2015. Looking at rates over the last month, we did see tanker rates come down from where they were in June and July. In July we saw VLCC rates of about $65,000 per day and Suezmax around 45, Aframax around 35. As we've gone through August and into September, those rates have all come down to about $30,000 a day across the board. And it's usual for this time of year that we see rates coming down. We are starting to get ready for seasonal refinery maintenance. So refineries are reducing their crude purchasing ahead of that scheduled turnaround. And we also saw some factors that affected the mid-sized tankers, especially in the Atlantic during August. We saw a reduction in Iraqi exports out of Ceyhan because of some problems on the pipeline there. And we continue to see low volumes out of Libya. And so that meant that activity in the Mediterranean region was quite low, and that affected the whole Atlantic market for Aframaxes. On the flip side, the product sector has been very strong over the past few months on both LR2s and MRs. And on the LR2s, it's a continuation of what we've seen in recent months of strong naphtha movements from the Middle East into Asia, and also an increase in cargoes coming out of new export-oriented refineries in India and in the Middle East. And the MRs continue to be pretty strong as well, with high refinery throughput in the US, meaning a lot of exports out of the US into Europe, Latin America and West Africa. So the product market's been very strong, with LR2 rates up around $50,000 per day and MRs in the kind of mid $20,000 per day range. Looking into September, we do think that the rates will stay fairly weak through September. Although on a historical basis, $25,000 to $30,000 per day, like the rates are now, is not too bad. But we will see refinery maintenance continue through September and possibly a little bit into October, and that will keep the tanker rates on the crude side low. But we do still expect a very strong winter market to emerge once we get into Q4. The level of global oil production relative to demand is still very high, which means that a lot of oil is going into inventories. And once refinery maintenance is over, that will mean that even more oil gets pushed into inventories. And that should keep the price of crude oil down, and it should also lead to a lot of demand from the refineries for crude oil and also for stockpiling. And then you put on top of that the normal seasonal factors that we see in winter, stronger heating oil demand and weather delays. And we think it could be a very volatile mix that leads to a very strong winter tanker market. Looking ahead into 2016, we think that the market stays pretty good through the first half of the year. I think the expectation is that oil prices are going to stay low in the kind of $40 to $60 per barrel range for the next 12 months. But as you get into the back half of 2016, I think we might start to see the crude markets start to rebalance a little bit. Over time, we would expect that low oil prices will lead to an increase in oil demand, while at the same time starting to reduce oil supply on the margins. We're starting to see that a little bit with US shale, which has come down from 9.6 million barrels a day to 9.3 million barrels a day. So as we go through 2016, that supply-demand gap should start to narrow, which should cause oil prices to come up a little bit, and that might just take away a little bit from tanker demand. And then also fleet growth does increase going into 2016 as well. This year we think the fleet will grow by about 2.5%, and next year we think it's going to be about 5%. We've actually revised that forecast up a little bit just on the fact that there's been hardly any scrapping this year because the market's been so strong. And if we think the market's going to be fairly good through the first half of next year as well, then we think scrapping should stay fairly low in 2016. And so that's just raised the overall fleet growth assumptions for 2016. But overall, we do expect a very strong winter market, a good start to 2016, but just some increasing risks coming in the second half of next year. So that's our update on the conventional tanker market, and we'll speak to you again next month.